Welcome to Retailistic, the official podcast of Coresight Research for December 23rd, 2025. This week, CEO Deborah Weinswig speaks with author and legend of retail Gilbert Harrison. Gilbert was the founder of Financo and the investment banker behind some of retail's biggest mergers and acquisitions. But before we dive into this fascinating conversation, let me give you a quick sampling of some of the research our members are getting this week on Coresight.com. We have an in-depth report on the new initiatives from innovators across mass merchandisers, warehouse clubs, and discount stores that U.S. consumers can expect next year. We are publishing the penultimate installment of the Holiday Consumer Behavior Tracking Survey we've been fielding since Halloween. We also have a couple of reports on the key retail festivals next year in both China and India. If you're not already a member of the Coresight Research community, make a note to visit Coresight.com and sign up. Now, here's Deborah and Gilbert.
Gilbert, thank you so much for joining us today. We're so excited to have you. Maybe start off, where are you geographically?
Right now, I'm at my home in Palm Beach. I'm sitting out at the pool, getting the sunshine before we go to Nevis tomorrow for our 60th wedding anniversary and my 85th birthday.
That's saying a lot, and that's all in 1 week. So that's a tremendous amount to celebrate, but also to be appreciative for. Let's start kind of at the beginning, right? I mean, when you and I first met, you were at Financo as chair, and really even at that time, you're a legend in the industry. I think for what you had created, for the talent that you had built, and for the runway that you had. But maybe can we go all the way back to, it was like 1971 from what I read, when Financo was founded. What was it that you were trying to do, and what was the white space in the market?
At that time, I was practicing corporate and securities law in Philadelphia and doing a lot of public offerings and mergers. These people would come in that said they were bankers, but really brokers, didn't have any idea of what was going on. And they were making $100,000 a pop, and I'm making $25,000 as a lawyer. 6 months away from being a partner, where I'll be making $60,000. So myself and my original partner decided to leave the practice of law and start a boutique investment banking firm, which we named Financo. Very interesting. Your viewers probably may not remember it, but at the time, INA was one of the largest insurance companies in the world. The person that was helping me decide upon a name said, let's do Financo because it has an interesting connotation. So that's where the name evolved. We left our practice of law. We financed ourselves to go for 18 months without doing a deal. And we're in business for 3 months. We sold an optical company to iTech, which at the time was one of the largest optical companies in the world, located in Boston, and we made $180,000 fee. Put that in today's numbers, and you probably have something close to $3 million. So we were off and running.
And how did that deal come about, and what did you learn from it?
Deal came about from a client of mine in Wilkes-Barre, Pennsylvania, that knew that a friend of his was selling his business. We met them, researched the company, and decided on 2 or 3 different alternatives and went to iTech, and they bought it. And as a result of that, we did other deals in the optical industry, including Lombard lenses, which we sold to American Sterilizer, working with hospital companies, and so on. So it was an interesting segment long before we got to specialize in the retail operations where we've made our name.
And what was it that was unique about retail, and why hadn't somebody tried to do this before?
Well, put it this way. I never really understood tech. I didn't understand high science. Retail was something that always fascinated me. As a young lawyer, I had clients in the retail business. We represented Alexander's, which was one of the largest department stores in the country. We represented Dage Bell, that was a retail company. I took Shoetown public, and they were, at the time, a discount shoe operation. I took Levitt's Furniture public, so that I started to have a background in retailing, and I understood it. It was very easy. The people were easy to work with. You could understand the business, understand the dynamics, understand how the various people were able to achieve their success. The numbers of retailing geniuses that had built up huge fortunes were amazing and still are amazing. But when you consider that it's not a simple business, but it's a business that has a lot of growth and a lot of potential.
What did you learn from, you'd mentioned kind of, various people's ability to achieve success. What were the common traits that you saw in those individuals that allowed them to have a different outcome than others?
I think that the CEOs or the founders of companies, and initially most of our work were with individually owned companies, private companies or public companies that were controlled by an individual or family. And what these people had was the unique ability and vision and entrepreneurship to be able to build a business. Having gone to the Wharton School and graduated from Wharton, then getting my legal degree, I understood the entrepreneur because unlike Harvard, Wharton really trained entrepreneurs, and I think it still does. So that this was the unique perspective that I learned from how these successful people and how they were able to make the money and build the companies that they did.
And if you think, it was interesting. I feel I'm a alum of University of Chicago, and I remember going back to campus, let's say 10 years ago, and everybody, they said, the number one company that was hiring out of, I think when I was there, it was McKinsey, and then 10 years ago, it was Amazon, and now it's actually banks again. And so, right, hey, what comes around goes around, if you will. But what do you think the opportunities are today in banking? And if Financo were to come to be today, right? Like let's just say fresh slate, how do you think it would be different? So two-part question.
Well, I think investment banking is unique because you have to have the foresight, the vision, the ability not only to work with numbers and to figure things out that way, but to understand people and be able to understand and negotiate with them and really to determine what are they after. When we're retained to sell a company, one of the first things we try to understand is what is the reason why this person wants to sell? Is it because a simple reason they want to cash out? Number two, whether they see the business slowing down, do they see the competitors gaining traction? Do they realize that they need to expand geographically and they can't find the means to do it themselves? But understanding what motivates the company to employ us or another investment banker is key to understand how people are able to grow and what their needs are.
Did you ever talk anybody out of doing a deal who came to you because they wanted to do something? Either.
Yeah, a number of times. Number one, on a simple basis, when we saw the company's expectations, we would do a valuation and we'll come up and say the business is worth such and such. If they came up and they said the business was worth 2 times or 3 times what we thought made sense, we would tell them we couldn't represent them and that it wasn't proper. Many times, these clients would go to another investment banking firm that really didn't care. They would just highball a number, get the client involved, and end up either selling the business at the price we said, or these people sometimes came back to us and let us have a second try in our own terms. There was a uniquely interesting situation just going to mention, but it was very funny when you talk about convincing people after it. The nephew of a prime boss had a legitimate company that was growing and very profitable. And he came to us at the legal firm. This is before I went into Financo, was when I was practicing law, and wanted us to take his company public. We looked at the numbers and they were terrific. But when we did the background check with him, we figured that he would never get out from the SEC scrutiny because of the family members. It was difficult telling him that, but one of the things that I've always done, and I've tried to do not only here, but throughout my career, is to be honest with the person. We told him about it. He stood and screamed. He came back to us a week or two later and thanked me and was very kind about it.
That's interesting. And you mentioned, I think, wrote down the Shoetown discounts shoes. Can you talk about what that industry was like then? And right now you have behemoths like in the off-price world, like TJ and Ross and Burlington. How has kind of off-price or discount changed over the years? And what's your prediction on that market?
Well, I think you got to look at three different things. I think you'll have to start by looking at the department stores. I did a paper for the International Department Store Group in, I think it was 1982 or 3. But I looked back at the department store growth in the industry. In 1955, there was something like 83 independent department store chains. Today, when I look at it, there's probably 9. And even if you take a look at the recent Saks Neiman's merger, maybe it comes to 8. So the department stores made a mistake. They got out of being a general merchandise company and went really into apparel. And this bill gave the ability of other entities to grow and samarized the big box retailers, the discount retailers, and so on. If you take a look at the discount industry, take a look at where Woolworth was back in the heyday and Kmart was, and then take a look at what Sam Walton came along to do and totally changed that whole industry to where basically there's no discount department stores left except for 1 or 2. And they've maybe changed their model of operation. Kohl's originally was a discount store. They're not. But everybody else, whether it was Bradley's or Gold Circle or whatever, are out of business. But Target still exists, and Target is strongly, but it's not in the discount range. In terms of the off-price retailers, I've sold a number of discounts. Loman's for one, Shoetown for another. Probably in my entire career, the best deal I did was merging Marshalls into TJ Maxx. At the time, Marshalls was sort of floundering. TJ's was growing, but it only had $1 billion market cap. Marshalls we sold for $550 million. 3 years later, TJ's had a market value of $3 billion. And today, the last time I looked, and you can double check this, Deborah, TJ's had a market value of over $160 billion.
That's crazy.
Just take a look at what they've done and compare it to where the department stores are trading at. I mean, even when you take a look at Dillard's, which is a great chain, or Macy's, which is growing under what you call new leadership, they're peanuts in terms of value, $10 billion compared to $180 billion. Ross Store is certainly second to TJ's, but doesn't have anywhere near the value. And interestingly enough, and I guess I can talk about it now since it's 40 years later, when Melville Corporation, which owned Marshalls, asked us to sell Marshalls, we thought initially that Ross would buy it because Ross was in the South and most of Marshalls were in the Northeast. So we thought it would be a perfect combination. But unfortunately, they weren't interested. And as a result, TJ's did an amazing thing, perhaps one of the most unique things that I've seen and tried to get others to replicate in the past is they put together Marshalls and TJ's. They decided not to close any of the overlapping stores because they felt that no more than 10% of the traffic would go into the remaining store. They combined the entire back of the house, which gave them huge synergies. Today, most people don't know that Marshalls and TJ's are owned by the same company. It was with the hundreds of deals I did, this was probably the most successful.
Yeah, they've done an amazing job of keeping their individual branding because if you think about when, Federated acquired May, and right, all of those individual kind of hometown brands, if you will, all those department stores lost their brands. And I still remember one marketing trip I did when I was at Citi, and I went to like Detroit and like Troy, Michigan. I was going to, kind of not exactly on the beaten path from an investor perspective, but I got to hear real people's stories, and they were like, I used to get like a paper bag and now I get a plastic bag. And so it was like a lot of the little tiny things that added up for the consumer to then have them kind of flip to a different retailer. And I think it's really interesting what you're talking about because, this Black Friday, we definitely saw a bit of a renaissance with regards to the department stores. I mean, everyone we talked to, right, it was unbelievable. People shopped earlier. They shopped more categories, more departments. We've seen, unfortunately, a lot of either consolidation or other store closures. Where do you think we are in the kind of like department store life cycle?
To some extent, we've run out of companies to merge. When you take a look at Macy's, you have Dillard's. Well, Federated had all these different brands because they bought up all these independent companies. What Alan Questrom, when he took over Federated and they merged Macy's in, was able to do, and it was a huge amount of flack that he had, was to convert all of these stores into one name, which gave him, it took away the individual enterprise that the individual stores had, but it allowed Macy's to have an entire portfolio and brand in basically every state in the union. And when you take a look at the way they've been able to advertise the 4th of July, this Thanksgiving Day parade, and other things to advertise throughout the country, it was absolutely an amazing feat. Although I had wished Macy's would be much stronger, and hopefully what Tony Spring is doing now to try to rejuvenate things will work.
We're definitely seeing kind of the green shoots, if you will. Going back to, we're down to very few kind of more traditional department stores. I think the consumer still wants to, and actually, right, Gen Z really enjoys shopping that way. So I think sometimes last one standing, the rewards go to them. So I think that was interesting.
Yeah, but one of the things that we didn't really talk about, and that is how e-commerce has affected the industry. It's totally changed the way the consumer shops. And the department stores were not initially, nor was Walmart, the first company to get into doing e-commerce. And if you take a look at what Amazon has been able to create, it's unbelievable what Jeff Bezos has done. When you take a look at some of the demise that's going on with some of the freestanding specialty stores, department stores, and other merchandising companies, shoe companies, and so on, Amazon has taken their lunch away.
No, they really are. I mean, it was interesting. I went to order gifts for the holidays. I was like, normally I'd be like getting the best price here and there. I was like, I just didn't have the time. So I'm like, I'm just gonna go on Amazon. I have to pay a little more for shipping and handling. That's okay. So right, like you're on the app, and I'm like, I've got all the gifts, right? And now I'm like, oh, okay, I need like some apples and whatnot. So I did it all in one place. It was insane. Once again, like living in New York, but right, like I don't know, it was like 8 ounces of cream cheese, like normally $4.99 branded. I got the Amazon brand for $1.49, and I'm like, who wouldn't do that like all day long? So it's like they make it easy and they've got price. And I, of course, personally love going into physical retail, but if you're short on time, et cetera, right, they can play a huge role in kind of like how you approach everything.
Forget about using the Amazon brand. What they've done with every other brand where they're able to sell it on their site is amazing. I mean, when I'm looking for something, the first thing I do is go to Amazon Prime. First of all, they have the free shipping. I put a pair of sneakers online the other day, a cord for my computer online, air tags for the trip we're taking. You can just get anything, and they deliver it very promptly.
Yeah, it's funny. My daughter wanted for the holidays this New York Times crossword puzzle book, and like I just couldn't find it anywhere, and so I found it like secondhand. I'm like, I hope too much of the puzzles aren't filled out, but I got secondhand on Amazon. So I'm like, even the kind of like harder to find, right? You can find there, and so I think that as a model.
Is eBay still a factor, or is it really dried up?
No, I mean, I think that eBay still plays, and now 80% of what they sell is current, right? That's more working with large retailers and brands and whatnot. And only 20% is more of this kind of marketplace. And you think about, right, they probably on the, kind of individual seller side, they're probably competing more with like a Poshmark where, that business still, I think it's great it exists. I don't think it's necessarily as strong as we would have thought at this point. And, as you start to see maybe some of these larger brands letting some of the smaller brands use their brands, I mean, I think that could be some of the change that we see. But as of right now, I mean, it's pretty unbelievable.
By the way, don't discount what Walmart has done. I mean, Walmart was late getting into e-commerce, but if you take a look at the growth and what's happened there, it's phenomenal. And you really have to start with Kmart, which was the leader in its field in its day. The problem with Kmart is they would open stores, shelter all over the place, wherever they got a real estate deal. Many of their people were getting paid off, so they would just go to locations. What Rob Walton and his team did with Walmart is they really developed the stores around a concentric circle of a distribution facility. And they were able to grow phenomenally that way. So you got to give them credit. And they got into e-commerce a little bit late, but they've done a phenomenal job with it.
Also, sometimes when you're late, you you can miss out on spending in places that are impractical. But I think that they've done such a great job on focusing on the stores, their associates.
Yeah.
And so I remember, I think it was last Black Friday, I went in and it's like, I mean, there's all the words around like Wi-Fi. I'm like, oh, yes, yes, yes. And I get to the register and they're like, Miss Weinswig, would you like to use Walmart Pay? I'm like, I didn't even know I had Walmart Pay, right? And so, and right, that was just the fact that I have Walmart Plus in my, I have a wallet there. But I was like, wow, this is amazing. And if I lived out in the burbs, right, it would be super easy to order from them. So yes, I agree that you've got these kind of two behemoths. And so how, like, as you think back, do you have a deal that you did that was so hard you were convinced it wasn't going to happen? What would that have been?
Well, the hardest deal I've ever worked on, which I can't talk about right now, and maybe in our next effort is a merger and an acquisition by a foreign company with a U.S. company that I've worked with on for 3 years, maybe 5 years. There's a sentence in my book that's saying, "Oh, wait for my next hurrah." Well, the next hurrah is probably not happening because I've been unable to pull this off. If it happens, I'll be glad to do another interview because we go through an entire history of the frustrations of an investment banker, where you have one side that clearly wants to do a deal and has the vision, and the other side that you can't move.
No, that's and maybe, you talked about your book. I remember I think you signed a copy for me and I read it right away. It was educational, it was entertaining, and it was fun. So I think I literally was one of those like I stayed up all night and read it. What was the impetus for you to write that and what was different than what you expected?
Well, I'll tell you, it was COVID,
Mm,
and we were sitting. I was down in Palm. We had come down from New York to Palm Beach and never went back. And I started to discuss maybe writing something for my family.
nice.
And what turned out to be writing an autobiography for my family turned into doing something for three people, three reasons. Number one, for my family. Number two, for young investment bankers to understand the trials and tribulations of being a banker and how much you have to love it and the confidentiality. And the other is to talk about the changes in the industry and the history of what we saw in the industry. What I would do is I put together an outline. I started to search for somebody to collaborate with. Your friend Stacy Burns gave me several people that I talked to, and there just wasn't the chemistry. I mean, the same way in a deal, if the chemistry isn't there between the principals, the same thing happened with me. It so happened that a friend of mine's son's roommate was writing books and doing things when I met him, and he helped me edit the book. And what I would do is I would sit on my computer at 3 o'clock in the morning and write a chapter or write something down. Then I would send it to him. Then he would connect me and we would do a Zoom call for an hour. And this went on, for weeks. And we put together the book. What he did was something I truly respect him for, is that instead of doing a chronological thing, this happened this year, this happened, he moved things around. And when you talk, I mean, I laugh, but when you talk about the first sentence in my book, where Financo was acquired by Lehman Brothers, and the first day I'm there, I had breakfast with Stephen Schwarzman. Stephen told me he was leaving to do something on his own. And I said, "Why are you leaving?" And he said, "Why are you coming?" Now, you know, I've done all right, but take a look at what he's done.
That's very funny, actually. Were there, like, maybe talk a little bit about how important was the asset versus how important were the people? How important were the people on the other side, right? What allowed some of these deals to get done or not get done?
I told you, it starts first about understanding what their motivation is, whether it's from a buy side or sell side. Second of all, it comes from understanding the principles and understanding what are their objectives. It comes to the chemistry. What's the chemistry going to be like between me as an investment banker, but more importantly, the buyer and the seller, especially if the buyer wants the seller to continue. One of the major things that is regretful is that a lot of companies bought companies and frankly got rid of the principals and got rid of the entrepreneurs. And they were never able to build up the business to where it should have been going forward. I can talk about a present day situation, and that is I met Stuart Weitzman because I knew him from Penn. He was in my wife's class at Penn.
Hmm.
And Stuart probably was one of the most amazing entrepreneurs and footwear executives I ever met, because what he was able to do, he was able to combine the merchandising skills that he got from his grandfather and father from being in the industry and the business training he got at work. He built up a business that I sold 3 times. Unfortunately, I wasn't involved in the last time when it was bought by Coach.
Mm.
And as public knowledge, they paid it, I think, $400-500 million for it and wrote it all off. It was making $60 million of EBITDA when we sold it to Coach. And evidently, people at Coach decided not to keep Stewart and much of his management. They put in new managers, new CEOs. I think they had 3 or 4 CEOs. It was very sad. The Coach finally decided to sell it, and as you know, it was just bought by Colaris. I'm not sure how they'll do with it, but they paid close around $100 million, which basically was the price of the inventory that they acquired. A sad situation. How one of the finest companies, and Stewart, as an entrepreneur, is very sad about it because he would love to see his name continue.
Is there Well, one thing I've always thought about in some of these deals, right, when I see them not go through, there's almost this like self-sabotage. Have you seen that happen, and what usually are the traits around that?
I think it's a combination of people overreaching, people being greedy, people not knowing what the other side wants, um, people maybe even waking up and saying, "What do I want this for?" I mean, there's just so many different factors on why a deal falls apart. In this deal that I'm working on now, it's a combination of all of these things, and whether the owner of this particular company really wants to do a deal, or whether the CEO has tremendous insight. I mean, who knows? Who knows? But companies overplaying their hands is one of the major reasons why a deal doesn't get through. Or if it's done and it's been and they overpay for it, it may be bound for failure.
Yeah, no, I mean you're completely right. And do you think that with this, like, I mean, what we're seeing in colleges today is, right, this new wave of kind of investment bankers. How do you think the industry will be different for them than it was for you?
The main thing that I see is I haven't seen the entrepreneurs, whether it's what I was when I was working, or what Steve Schwarzman was doing, or what Jimmy Lee at JP Morgan was doing. You know, I can go through a handful. And are there the people? Sure, they're smart, they're trained, but do they have the feel? Do they have the chutzpah? Do they have the drive? Do they have the love to be able to do it? I don't know. I've seen a lot of them, but a lot of them aren't. One of the interesting things is I was on the board of Wharton for 17 years, and we saw a huge amount of people from Wharton wanting to enter into investment banking. They would go because the money was there. When we went through a recession or a dried up crisis, the numbers would drop, but the number of people that were applying for these jobs were much more talented because it's really what they wanted to do, which goes into the love of what you're doing. I don't care who you are or what you're doing as a young person going into any type of business. I don't care whether it's investment banking or anything else. You have to wake up in the morning and like what you're doing. If you don't do that, it's a disaster and your life is hurt. I mean, today, I miss the everyday. I don't have 50 people working with me. I'm a senior advisor to a couple of companies. I'm on the board of a great company, Inter Parfums, which is based in Paris, which is just a phenomenal fragrance company. I have built some tremendous brands. But all of these things are things that I've done and I'm proud of. But I just tell anybody in this industry, you got to love what you're doing. I think you also have to understand and respect the people you're working with, the chemistry, which I meant before, the confidentiality. You can't talk about a deal. It
Yeah.
is absolutely, I mean, we had one situation where the chairman of the bank's wife, who was financing a deal, went to the store manager, who was a retail store, and said, "My husband is financing your company. You better give me better service." And of course, nobody knew about it. I mean, you know, crazy things happen. We've had people, when I was practicing law, a very famous story is that a client was coming from New York and was on the Metro liner coming down. And the people sitting next to him were talking about the way they were going to kill this lawyer in a meeting that was at 11 o'clock. And my guy had a meeting at 10 o'clock, and he went in and told the lawyer the entire strategy. I mean, you can't talk. I mean,
No.
confidential is just so incredible.
No, it's interesting, right? There are certain restaurants in New York and other places, right, where we all kind of flock to. I remember I was at the Langham. I mean, literally, first of all, the restaurant was like wide open. I don't know why they put it right next to these people. I was just waiting for somebody, and they're talking about like a deal. So I like literally went to the waitress, whatnot, and I said, "Yeah," I said, "You have to move me, right?" Like it's just like kind of recuse myself, if you will. But I was like, I've got to physically move because I don't want to have this. And I think you said something that's very important. I think that people treat it more lightly these days is this idea around like true confidentiality and actually what that means. Because people will be like, "Oh, I'm working with a very large company in the Southeast and blah 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 blah." And I'm like, "Yeah, I don't know if you're supposed to be saying that."
Well, what you can't understand, many of the times it comes from the junior bankers, not the senior people, and they want to brag about something. I mean, it was
Sure.
it was very funny today. I'm in Palm Beach, and my wife and I are having lunch at the Breakers, and at the table behind us, three investment bankers from a firm I know were talking about a deal. We just sat there sort of laughing because we knew it wouldn't happen, you know? But
Crazy.
those are things that go on, you know?
Yeah, it's interesting. There's a certain point in your career, well, maybe, where you start to become more like hyper aware of that. So I remember I used to be on airplanes, you'd be talking about things and then there's a switch where I was like, I'm only talking in the bathroom, right? Of course, before we take off. But it goes back to just being kind of much more careful. So one question on, I mean, I'm sure there's many amazing stories around some of the deals you worked on, but is there one where, you had like a big reversal when the kind of bad counterparty became like the best partner or something like that? Because I always love it when things turn around at the end, right? Like it's like a fairy tale.
Well, there's a lot of there are so many companies that didn't do what they should have done after a merger. I really don't like trashing anybody. It
I don't want names. I just want like circumstance.
well, as I said before, they fire the entrepreneur. Other cases, they make a deal when they buy it, paying the entrepreneur based upon increased sales. So the guy builds the business, doubles the sales, but forgets about the margins and the profits aren't there, but he's still getting paid under his agreement. You know, I can give you 20 other examples like that where stupid things are done. People don't want to pay what they should be paying, and so they buy somebody that's mediocre, and they're paying 4 or 5 times as opposed to getting the star where they could pay 11 or 12 times, and the business ends up failing and never being able to grow. I mean, other people. I think one of the things that we've seen, unfortunately, is a lot of companies, sometimes European and Asian companies, have come into the United States and they don't understand the culture and they do it their way. I mean, perhaps the most interesting thing is there was a company in France that bought the old Corvettes, if you remember Corvettes. I mean, I'm told your viewers may not remember that. And at the time, I was representing Levitt's Furniture, and the CEO of Levitt's Furniture came from Montgomery Ward, and they were contacted when Montgomery Ward was a great company before it fell apart, and we flew over on the Concorde to France to meet with the owners of Corvettes. Because one of the stupid things that they were doing was they decided in France you don't have to pay your bills for 60 days or 90 days. In the US, in a department store, if you don't pay your bills in 30 days, you're in trouble. The Corvettes suffered.
Oh, I'm sure.
And we ended up not doing the deal. The interesting thing is the Corvettes was owned by Velo Industries, which was the largest textile company in France. We met to negotiate in the offices of Christian Dior, which they also owned. It turns out they went bankrupt, and the receiver that was put in to the company was Bernard Arnault.
You're kidding.
He liquidated everything but Christian Dior. I mean, you can read about it in his book, but I was there. He liquidated everything in the company except for Christian Dior, which became the whole basis of the growth of LVMH. Incredible, incredible story. I don't know whether I put that in my book or not. It's a story, it's something I'll always remember.
Well, you start to look at some of those decisions that were, kind of truly changed the outcome of one of these retailers or brands. And I mean, for the most part, it's usually, right, M&A activity. And so as you think about kind of as we go into the future, right, you talked a little bit about, kind of online, offline. What do you think is the power of the store going forward? And do you think you see a change in ownership in terms of who owns retail?
I think, first of all, the consumers still want to touch and feel. If you take a look at the comeback of retail, you'll see a lot of these vacant stores, especially in New York, are all of a sudden filled again. Many of them are flagship stores for brands that are doing it for advertising. But the consumer wants to come shop. Sure, they can look online, they can take a look at what they want to buy, but they want to go into the store and actually buy. So I think that don't underestimate what the consumer wants and how they react. I think that's an important factor. I think the consolidation that's going on in the industry has held off a lot of competition. While in some cases it's given better prices, in other cases it just doesn't work. I mean, if you take a look at right now, not in this industry, but what's going on with Warner Brothers, with Netflix and Paramount, the major concern is, well, combining these two companies, whoever wins, is that's going to stifle competition? Is that going to, they claim that it's going to make the cost less in terms of streaming, but it probably make it more. I mean, it's complicated.
You just set up
Not
the
easy.
the one question I haven't gotten to that I'd really love to unpack is what led to, like, the WHPs and the ABGs and the Caleres, like, all these we can I don't know you want I call them brand aggregators, I'm sure there's a better word for them or words, but it's like I felt like they kind of sprung up, and I was probably in Hong Kong when this was all happening, like, sprung up out of nowhere. I mean, WHP was, like, born out of the pandemic, but if you look at the amount of retail they own now, it worries me that, a lot of these folks are fighting with, like, one arm tied behind their back. How do you think about that whole I don't even want to call it an industry or ownership structure? How do you think about it? And what do you think is the impact has been on retail?
First of all, I think what a lot of these, I don't want to talk about any particular ones because I got my own feelings
Mhm.
about them, but they're basically buying dead brands, sick brands, and trying to remake them, trying to leverage them in terms of bringing the operations into other foreign countries where they basically become a licensing company because they really don't operate the stores themselves. They get somebody else to operate and they just collect the royalties. How long and how good they'll last, I don't know. And I don't want to. I have my own feelings about it. But right now, they're doing well. Their investors are doing tremendously. I think ABG now has what, 10, $15 billion of revenues. I mean, it's humongous, but it takes a lot of the drive out of it. I mean, I'll give ABG credit because some things they've done well. I mean, it's a shame what happened to Brooks Brothers. I mean, I can mention this. When I was retained by Joseph Bank before they were taken over by Men's Warehouse, which was a disaster.
To say the least.
We were going to buy Brooks Brothers because it was a different customer, but Joseph Bank could use their real estate and merchandising expertise really to grow the business. We were willing to pay about 800 million. The owner wanted $1.4 billion. We might have gone up to $1 billion. We were at $800 million. We didn't. And then Brooks Brothers went bankrupt and ABG took it over for like $200 million. I will tell you, I give them compliments on that because the quality of the goods have not diminished. Their shirts are excellent. They've done a great job. It could have been something different, but I give them credit for their doing that.
Yeah. But
And
but do you
every situation is different.
Do you think, like, I've just started to, we're at Coresight, we're doing a big for the banking industry. I was just interested, right? Because when I was in it, you saw so much M&A activity of, right, the banks. And, like, how did that change, right, the industry? And so I just, right, because if I think about the companies I covered when I was at Citi and Morgan Stanley and all that, I mean, many of those companies don't exist anymore. And I was covering more big box, but the landscape has changed so much. And then you have that. I look at it as like you're throwing like the oil, right, is these kind of brand aggregators, and that's kind of changing everything. And in addition to some of these other exogenous factors, maybe they all just become licensing companies. But does that make the industry more or less competitive? And
Well,
you know,
I think it's become less competitive. I don't think the entrepreneur is there. You see the entrepreneur in tech. All right. You see what they're doing, but you're not getting the entrepreneur in retailing or apparel that you had before. It's a different industry. It's the entry is harder, a huge amount of startups that are looking for money, but you don't know who's going to succeed. I mean, one has to remember that forever many Ralph Lauren's or Calvin Klein's or Tommy Hilfigers are out there and have become a success. They've done it through the ability, through luck, through timing, through financial abilities. But for every one of them, there's probably 100 that maybe could have been just as capable, but get nowhere. It's hard.
Yeah, that's a very good point. So, Gilbert, I feel like we just scratched the surface and we're already at almost an hour, which is crazy. But it's
It's
interesting.
been fun. It's been fun.
It's been great.
Yep.
In the past few weeks, surprisingly, I've had a few of my friends who have kids either as sophomores or juniors in college who are looking for summer internships, and everyone's finding it a bit difficult in banking right now. I think a lot of I think that going back to I think that industry has kind of had a bit of a resurgence. What would you tell people who are in college, recently graduated? Where should they spend their time? How should they kind of find their what you talked about? How can they find what makes them tick and what they love to do so they get up every day, right? And they can't wait to get out the door.
Well, one of the things that's very interesting is at Wharton, they've established the Baker School of, of entrepreneurship. They really are helping a lot of these young MBAs and undergraduates find their way into the industry and trying to get them into merchandising positions, getting the companies to pay the going wages so that they're at prices that are competing with the McKinseys and so on. Every investment banking firm, though, today has maybe 20 or 30 or 40 people applying for every job that's
Yeah.
open. So
Yeah.
that's what, and I mean, it's the same thing as getting into colleges. The number of people that are qualified but compared to the positions just aren't there. So it's very, very hard. The individual that wants to do this has to keep persevering. You have to accept your knocks, but get up and try again. I mean, in my business, I'll give you one funny story before we end. Early in my career, I was written up in the Wall Street Journal, and one of my mother's friends says, "Jesus, what is your son doing?" My mother said, "Well, he's working on a number of deals." So they said, "How many deals do you close? How many deals do you work on?" So maybe 50 deals a year. How many deals do you close? Maybe 10 deals a year. So the friend says to my mother, "Why don't you tell your son just to worry about the 10 deals and play golf the rest of the time?" The fact is,
It works that way.
you never know which of the 50 deals are going to be the 10 deals. So, but you got to keep look, this deal I'm talking about, I feel I've been knocked down on, but I'm up and trying, and maybe I'll be able to resurrect it. Maybe something else will come along. I don't give up. And that's the biggest advice I can give to anybody that wants to be in this industry, because they'll have a lot of disappointments that are not in your control. Remember, if you're a banker, a financial analyst, a consultant, you can give advice, but it's their money that's going to do it. And while you want them to do it, there's no way that you can, people, if you push too much, they'll say, "Oh, all you're doing is after the commission or the fee," as opposed to realizing that it's something that's important.
That's a good.
This has been fun.
No, this has been great. So, okay, so last question. What do you think from, let's just call it your formative years? So, whether those were young child, maybe high school or college, what was it that gave you the confidence? Because, right, when people are telling you no so much, that can, right, some people that would really affect them in a way that they wouldn't be able to continue to move forward. Where do you kind of pull that confidence from? And obviously, which is what's made you so successful, but what do you think that was?
I think it's a combination. It made me think a combination of a couple of different things. Number one, in high school, I became part of a junior achievement, which was an entrepreneurial. I sold tie pins and clasps. I was editor of my high school paper and an editor at the Daily Pennsylvanian, and in fact interviewed President Kennedy. When I started in law school. My father had some financial problems, and I started doing some work to earn money. And it was the time that cheap fares and group fares were coming into practice. And I ended up with working with a travel agent. We organized 600 students going on charter flights. I got all of my friends at different universities to bring in their people, sent 600 people to Europe. People got paid, besides a free flight, I made $10,000 as an entrepreneur. This is 2 years later when I started practice law. My salary was $7,200. And when I got married, it went up to $7,500. I almost flunked out of law school. The dean asked me, "Do you want to finish your law training, or you want to continue doing the entrepreneur?" And I decided to continue as a lawyer. And from the bottom of my class, I ended up in the top of the class. But I had that drive because my father was having financial problems. I wanted to succeed. Drive is drive is drive. You got to make sure that this is what you want to do and how you want to do it, and you got to keep going. But I think people at an early age know what their abilities are.
Yeah, well, it's knowing what your abilities are, and then I think also, do you like what the opportunity is with which you can match your capabilities, if you will? And I think that is, can be some of the challenges. And, it goes back to, right, as I'm increasingly, once again, advising my friends' children on either where to go to school. And I'm like,
I
and you
do it. Look, tonight at 7 o'clock, my grandson is going to find out. He's on the waiting to early decision at Wharton. I don't know what's going to happen. I'm advising grandchildren, friends on college, on careers. I get these conversations all the time, and I'm more than happy to meet any young person and talk about how I can help them. That's just me, and it's the way I am.
I think that's great. I think all of you listening should take Gilbert up on that, because he truly has an unbelievable perspective on the industry, on what's changing. And Gilbert, I still don't know how you kind of stay on top of so many things. It is really unbelievable. Thank you for joining us. This is just a pleasure, and we look forward to really.
One other thing that's important is that if you're successful, you have to give back.
Yeah.
You have to give your time. You have to be involved with charities. You have to do good. And that's very, very, very important. And we didn't talk about that. I could go on with that for another hour. All right?
I think that's, and I will tell you, when I started off in Wall Street at Morgan Stanley, I was part of something called Student Sponsor Partnership. And what was so interesting is you had money people and you had time people. I was a money person when I started, or a time person, and I was matched up with a money person who was great, right? As a younger person in the organization. And what you learned about senior leaders who were very philanthropic, and how that really kind of fueled their,
Yes.
it like they were different. And I really, I felt like I learned so much from that. And so, right, giving someone that gift when they're early in their career, I think that also changes them as well. So I think that's an excellent point, Gilbert, and definitely one people who are listening to this should really think about. So do you have a favorite charity?
I'm involved with PEN. I'm involved with the UJA, the Jewish Appeal. I was on the board of the Southampton Hospital and treasurer. There are just so many, so many opportunities. The Wharton School, I was on the board for 17 years, was very important. Jewish charities, and I was chairman of the merchandising group at UJA. I was part of the original bond group, young professionals for Israel bonds. I mean, a lot have been Jewish charities, but certainly school charities are very important as well.
Absolutely. Thanks again for joining us, Gilbert, and happy holidays.
Thanks, the same to you, and I'll talk to you soon. Thanks, Deborah. This was fun. Bye-bye.
This was great. Take care. Thanks, Gilbert.
Thanks, Deborah. And thank you for joining us this week. Coresight Research serves our members with leadership communities, data resources, events, event coverage, strategy sprints, proprietary research, and more. We have some very exciting additions coming in 2026, so visit us at Coresight.com and register so you don't miss out. Have a wonderful Christmas and New Year, and we'll see you again after the holiday break.